Good afternoon, everyone, and thank you for joining us today. We're excited to have over 500 people register for the event today. That kind of turnout shows just how much interest there is in the SBA 504 program and how we're all wanting to help the small businesses in our communities. My name is Kurt Chambliss. I'm the sales manager at TMC. I'm joined today by our SVP of Underwriting, Ron Lean, along with a few others on our team, Jessica Pachev, who manages our closing department, and Jennifer Davis, one of our SVP Business Development Officers, who will be monitoring the chat. So during the presentation, please feel free to ask questions in the chat. The Q&A box can be found within the upper left-hand side, I believe, of the Teams. There's 3 little dots that you click on and some instructions in there as well. So please feel free to enter some questions as we progress. We know our audience today includes both seasoned SBA 504 pros, as well as some folks that are newer to the program and have never done an SBA 504 loan. Our goal is to make sure that everyone walks away with useful, actionable information. I'll kick things off with an overview of the program, what it is, how it works, and why it matters. And then Ron will go over the latest changes. There's been a lot of changes over the last year or two, and especially with the new administration this year, there's been a lot of updates. So we're happy to share that information with you today. Jessica will talk after Ron, and Jessica will be going over some closing and servicing information for you. For those who may not know us, TMC Financing is one of the top CDCs in the country. A CDC is short for Certified Development Company. There are over 200 CDCs in the country, and if an applicant wants to get an SBA 504 loan, they are required to work with a CDC for the approval and funding of that loan. At TMC, we're passionate about helping small businesses with their owner-occupied properties, whether they're buying a building to become owners versus renters or refinancing existing commercial property loans. We are proud to be a leader in the SBA 504 space. Before we get started, I'd like to introduce Ron and have Ron say a quick hello.
Thank you, Kurt. It's great to see some familiar names in the audience today, and great to see so many new names in the audience today. Thank you for joining us. For those of you who don't know me, I'm Ron Lean, and I am the operations manager here at TMC. Appreciate you all spending part of your afternoon here with us, and hope you find some value in this presentation today. Kurt, is there anything else before we jump into it?
Yeah, so I want this presentation to be interactive. So as I mentioned earlier, please do use the Q&A box for your questions. We'll answer some of these questions during the presentation, but we'll also have a section at the end to go over additional questions at that time. We're going to be covering a lot of information today, but if you could just remember one thing, let it be this: call us. You don't have to be the 504 experts. That's our job. The more you know, the better. But we also understand that you have a lot of other products and services that you offer. So rely on us. Our website, tmcfinancing.com, has a list of all of our business development officers. Our business development officers love to talk about deals. They like to talk about structure, eligibility. You are not wasting their time at all by calling them. We encourage you to call us on little questions you have. I had a call this morning where it turned out that 504 wasn't the right product, and that banker was not thrilled with the answer, but was very appreciative of knowing that 504 wasn't the option, and he could pursue other options. So call me, call Ron, call one of our 13 business development officers, and we will be sure to get you the information you need. So with that, let's dive in. So TMC Financing is a certified development company, and our mission is to promote economic development and job creation in the states of Arizona, California, Hawaii, Nevada, and Oregon. TMC Financing is the #1 provider of SBA 504 loans in the country, and we've been the #1 CDC for the last several years. We've been advocates for small businesses since 1981. We funded projects totaling more than $14 billion, nearly 7,000 businesses. We've helped nearly 7,000 businesses, and we've created an estimated 60,000 in new jobs. So let me start by giving an overview of the 504 program. The program is designed to help small businesses gain access to affordable capital. We help small and medium-sized businesses finance fixed assets such as owner-occupied commercial real estate, land. We can provide ground-up construction and renovation costs. We can finance large pieces of equipment, and we can also provide debt refinance of commercial real estate, owner-occupied commercial real estate. We work with a wide variety of industries. So a couple of pictures here in the slide. Auto mechanics, auto facilities, a lot of service industries we work with. The second slide is a warehouse. We work with manufacturers and distributors. We work with a lot of professionals. The slide is a dentist, so we work with dentists, plastic surgeons, dermatologists, wide variety of medical office space are available for SBA 504 financing. And the last slide is a piece of equipment. It is a ferry that services the San Francisco Bay Area. It's a large piece of equipment, but it was eligible for SBA 504 financing. So we can do equipment, large pieces of equipment, in addition to commercial real estate. Some of the highlights with the 504 program, I would say the biggest single highlight is the low down payment. With conventional financing, generally it's 25% would be a rule of thumb as far as the down payment. A lot of businesses don't have 25% to put down, or if they do have 25% to put down, they would rather use some of that capital for other business uses. So leveraging their working capital in a smart way allows them to buy commercial real estate and still maintain an adequate working capital. We don't generally take additional collateral. The SBA 7A loan sometimes takes additional collateral on an applicant's primary residence or other real estate. We generally do not do that in SBA 504 financing. We do offer fixed rates. We have 25, 20, and 10-year term loans, all fully amortizing and all fixed rate loans. There's no limit on the total project cost. There is a limit of $5 million with SBA financing in general, but I'll explain in a little while about how that is not a limit for the total project cost. We provide financing for building acquisition, renovations, new construction, ground-up construction, equipment-only projects, as well as refinance of commercial real estate debt. One thing to point out is if a business is new, they would be required to inject an additional 5%. And by new, that means a business that has not been generating revenue for 2 full years. If they've been generating revenue for over 2 years, then they are considered an established business, but younger businesses would require the additional 5% injection. The other caveat is that special purpose properties do also require an additional 5% injection. I'll be going over a list of different property types that fall into special purpose properties. And if we have both situations, for example, a brand new gas station, a new business, and it's a special purpose property, then the down payment would be 20%. 10% standard, 5% because it's a new business, and another 5% because it's special purpose. So a brand new gas station would be 20% down deal. One of the other really nice things about this program is the low rates that are offered. The SBA 504 comes with a 25-year fixed rate loan the rate for July was just announced this morning. It is 6.37%. It's the same rate all across the country. So everybody that gets funded in a particular month gets the same rate. And if you compare this to prime is 7.5% right now, and a common SBA 7A rate is prime plus 2. So you can see on the chart the prime plus 2 in red is significantly higher than both the 25 and 20-year fixed rate that the 504 has to offer. So structure. This example gives a structure of a $3 million building purchase. With this type of structure, it would come with a bank first mortgage permanent loan of $1.5 million. The bank would also provide a bridge loan or interim loan at 40% for $1.2 million. And then the applicant comes in with 10% or $300,000 down. This is the structure of how escrow is closed. At this point, the seller is paid. I can point out that the interim loan, where I say the bank interim loan, generally that is provided by the same bank that provides the first mortgage financing. However, that is not required. There are some banks and financial institutions that will only provide the second mortgage, so the interim loan. So if your bank does not want to do the interim loan and just wants to fund the permanent first mortgage piece, that is an option, and we'd be happy to talk to you about that. After the close of escrow, generally 45 to 60 days after the close of escrow, we look to fund the SBA permanent loan. And in this example, the SBA permanent loan would be $1,230,000. The fees that go to the program and help support running the program are included into the SBA second. So the applicant does not come out of pocket for the SBA fees. That gets added in, and the applicant pays those fees over the life of the loan. As I mentioned, there's no maximum total project cost. So this total project cost is $3 million. But the important thing to remember is that there is no limit on the bank first mortgage. The SBA second mortgage is generally limited to 5 or sometimes $5.5 million, but the bank first mortgage can be $10 million, $13, $15 million. So if you have a $15 million first mortgage and a $5 million SBA second, along with $3 million down payment from the applicant, we can start to do some very large projects under this program. Here's a different way to look at the structure. In this example, it's a $5 million purchase. We have the same 50-40-10 breakdown, 50% from the bank, 40% from the SBA. And then in the lower half of the slide, it goes over the fact that the bank rate on that first mortgage is up to the bank. In this example, it's 6.25%, but that's up to the bank. Sometimes that rate can be lower, that rate can be higher. The term does need to be at least 10 years. The amortization can be whatever you want. 25 years, in this example, it's 30 years. You can have it be 20-year amortization. You could have if the bank wants to do a 25-year fixed rate, a 25-year fully amortizing loan on its first mortgage, that's up to the bank. So the rate on the bank the rate structure, term, prepayment penalty will all vary from bank to bank. And there are some parameters around it, but for the most part, generally speaking, we see a 10-year term with a 25-year amortization would be the most common. And then the SBA second, as I mentioned, 6.37, 25-year fixed rate, fully amortizing. Gives a nice blended rate of 6.3 in this example.
Bert, I have a question that was
Sure.
submitted from our registrations. And the question is 10% the required injection? So could somebody, assuming it's not a startup or special purpose, can they inject more than the 10%? Can they inject less than the 10%? If you could address that for us, that'd be great.
Sure. Yeah, good question. Yes, number one, you can inject more than 10%. Whether it's required on special purpose and those newer businesses, but even if it's a general purpose property and an established business, and they have additional cash they want to put in 20%, we can that's very common and okay. We can look at the structure on the remaining amounts. If it's a general purpose property and the applicant wants to give 20% down, the bank first mortgage could be 40%, the SBA second could be 40%, and then the applicant puts in 20%. Conversely, if they don't want to inject the 10%, there are some ways for that business to borrow the 10%, but they still need to inject at least 10%. By borrowing it, sometimes we see seller carry financing, where the applicant comes in with, let's say, 5%, and the seller puts a third deed of trust on the property. That can happen. They can use an equity line or other sources to borrow that 10%. We need to know some of the terms and the payback of how that works, but yeah, there are some ways to have situations where somebody comes in with less or borrows the 10%, or if they want to inject more, that's okay too.
Great, thank you.
Okay, so some unique properties. This slide lets you know that 85% financing for special purpose properties is another nice benefit of the program. I've listed here a bigger list of the special purpose properties that we can finance. This list does, or this special purpose properties do require that additional 5%, but to be able to finance 85% for assisted living facilities, nursing homes, car washes, farms, golf courses. We've actually done a few golf courses recently, do a number of gas stations. We are hospitality. So we're the #1 leader in hospitality lending. We've done over 40 hotel loans this year alone. We do marinas, we do tennis clubs, pickleball, theaters, auditoriums, vineyards, wineries, any business that is actively using the property, whether it's one of these unusual properties or a warehouse, distribution center, any business that's actively using the property is likely eligible for SBA financing. With a special purpose property, the bank is required to be at least 50% of the project cost. So in a general purpose property, I gave that example a minute ago where somebody puts 20% down, the bank can go to 45 or 40% on their piece. But on special purpose properties, the bank is required to be at least 50%. And since the applicant has to put in that additional 5, that means that the maximum on the SBA 504 piece is limited to 35%. The rate from the bank in this example is a little bit higher, 7% than the previous example, because it's a special purpose property. But the cool thing is the SBA rate is still that same 6.37. So even if it's a special purpose property that is relying on projections to get approval, everybody that's funded in a particular month benefits from that same low fixed interest rate. I'd like to touch a little bit on eligibility and size standards. We don't want the word small in small business administration to deter you from helping your clients. Many small and medium-sized businesses are eligible for SBA financing. We can look at it in 2 different ways. We can look at eligibility and size standards in 2 different ways. Tangible net worth not to exceed $20 million on the business's tax return. Also with average net income not to exceed $6.5 million after taxes over the past 2 years. Right there, I mean, those are some pretty large businesses. Many people don't consider those to be small right off the bat. However, if some of these standards are exceeded, we do have another way to potentially qualify the applicant for financing. We can look at the NAICS code on the business's tax return and potentially qualify them in this alternative size standard. So the example that we give here is a manufacturer, and for its NAICS code qualification, they can have employees of up to 500. So in this example, if a business has $30 million worth of tangible net worth and they're making $10 million a year net profit after taxes, they only have 490 employees, they are still eligible. They can still qualify because they qualify under the industry code qualification. The other thing to point out with eligibility is the business must occupy at least 51% of the space. If it's a ground up construction project, they have to start at least 60%, and they cannot lease out more than 20% long term. We can go over some of the details if you have ground up construction projects to make sure that those details are clear. But the intent of this program is for owner occupied commercial real estate, and we do need the business to be in the majority of the space.
And Kurt, before you go to the next slide, I have a question on this topic specific to the NAICS code. If a borrower established a NAICS code years ago and it's subsequently changed and they're now a manufacturer, do you know if they're able to change that or how SBA looks to that? Or maybe Ron, this would be a question for you as well.
Good question. And I remember a deal where I was able to get a letter from a CPA, and the CPA confirmed that the code on the tax return was incorrect, and SBA was okay with that. But I believe just somewhat recently, the SBA has been a little bit more firm. Is that correct, Ron?
Yeah, the SBA does go back and forth on this topic a lot. The current guidance is that the applicant is still eligible. What they will need to do is just have the last filed tax return amended to show the correct manufacturing NAICS code. So at the moment, they are requiring an amended return when it does impact eligibility.
Got it. Okay. But good to know that you can still get that deal approved.
Yeah, good question. Thanks, Jennifer.
Great, thank you.
Earlier, I had mentioned a $5 million cap, and with SBA financing, there is a $5 million cap, and that cap is aggregate of both SBA 7A dollars and any second mortgage from a 504. However, the SBA has fortunately allowed a couple different ways to exceed that $5 million cap. And one of the ways is by going green. There are two ways to qualify for going green. And one way is by energy reduction, and another way is energy production or generation. If in order to qualify for the energy reduction, the business does need to be relocating from one building to another. And they need to be leaving their current facility and moving to the new facility. It is not allowed on expansion deals where if somebody has an existing building and they want to have a second location, that doesn't work for the reduction component. But if they're moving from one building to another and that new building either currently uses 10% less energy per square foot than the previous one, or if they can include energy saving improvements into this new project that would reduce the consumption by 10%, that could qualify. And some of these items could be better lighting, LED lighting. It could be better windows. It can be a new HVAC system that draws less energy. So if we can show that the new project is using 10% less energy than a business that already has, for example, an SBA 7A loan, could also now qualify for a $5.5 million SBA second. For production, the most common production is solar panels that are either on the roof or potentially in the parking lot. If we can include solar panels that produce at least 15% of the building's energy need, that's the other way to qualify for green. Applicants can now have up to $16.5 million in SBA seconds under the green program with the 504.
Along the lines of the maximums, there's been some discussion around increasing the limit for the 504 loan. Kurt, if you could speak to that, that would be great. What the update is there.
Yes, we're super excited and we are monitoring that closely. It's our understanding that there are two bills that are working their way through Congress. One is tied more closely to manufacturers and giving manufacturers a $10 million, up to $10 million SBA second. And then the other is more general. I think it's any business would qualify for up to a $10 million in total SBA financing. I think that bill is both 7A and 504, increasing the limit from that $5 million to $10 million total. So from what we understand, there's positive reviews from both sides of the aisle. We haven't seen a whole lot of pushback from anyone, and especially on the 504 side, we are a non-tax. We're not subsidized by taxpayers. So the fact that the fees help generate the program's expenses is viewed favorably by both Republicans and Democrats. So fingers crossed, and we'll keep you posted on those potential increases to the limits.
Great. And really quick, I just want to acknowledge to everybody, Kurt is having some difficulty, I believe, with his camera. So we'll go ahead and make sure that gets fixed when we turn it over to Ron, or do our best. But we can hear you perfectly, Kurt.
Oh, shoot. That just started this morning. I apologize.
Not a problem. We just wanted everyone to know that we know, and but we can hear you beautifully. So please continue.
Okay. Thank you. The other way to get around the $5 million cap is if the business is a manufacturer. So manufacturers do not have to go green. Any manufacturer that falls into one of these NAICS codes, the 31, 32, or 33, qualifies for an additional $5.5 million on the SBA second per project. There's no limit to the number of projects that a manufacturer can have. So a manufacturer could have 5, 6, 7, $5.5 million seconds. In order to qualify, the NAICS code on the tax return does need to be in one of the sectors of 31, 32, or 33. But there's a lot of businesses that fall into this category. Food manufacturers, electronics, chemical manufacturers, automotive parts, outdoor equipment, paper manufacturers. All of these businesses are eligible, and they could have a $7 million 7A loan and also get multiple $5.5 million SBA seconds. The refinance program. The refinance program has been around for a number of years, and it keeps on getting better every year. So there are two programs under the SBA 504 refinance. There is refinance with expansion, and there's refinance without expansion. And so there's different parameters in both of those. By expansion, the SBA generally means improvements to the subject property. So if a business has a $1 million loan on their property and wants to put a new roof and build a new wing onto the facility, that would be refinance with expansion. If they're not looking to improvements, that's refinance without expansion. In both programs, at least 75% of the original loan had to have been used for eligible fixed assets. Eligible fixed assets meaning the building, land, something to that effect, and the other 25% for some other business use. But if, for example, 70% of the original loan was used for the building and 30% was business acquisition, well, that would not qualify because we're not hitting the 75% threshold. This program is really great, though, because it's able to refinance some of the higher interest rate loans that are out there. And the other thing that the refinance without expansion program does, it allows borrowers to access equity that is in that property. So they, on the refinance without expansion, cash out for working capital is allowed, and it really is beneficial to a lot of small businesses. I'll touch on a couple updates on the refinance program. We can now refinance SBA debt. We can refinance current SBA 504 loans. We can refinance 7A and USDA loans. There's some parameters and restrictions around it, but we are doing a lot of 7A refinances right now. The debt only has to be 6 months old. It used to be 2 years that the debt had to be in place, but now it's only 6 months. And they've increased the loan to value, so with cash out. So if cash out used to be limited to 85%, it's now 90%. And there's no longer a cap. There used to be a cap of 20% of the appraised value. Now that has gone away. So we can do full cash out up to 90% loan to value.
And Kurt, is that on special purpose properties as well?
It is, yes. And that's just an amazing product for small businesses that have. Oftentimes, small businesses get a 7A loan for special purpose properties because it was the only thing available at the time, and that's great. It served its purpose. But for us to then be able to now refinance that adjustable rate into a fixed rate, give them cash out, and it's a special purpose property, it's a triple win.
Excellent. Thank you.
Here's an example of refinance without expansion. This is our more common request. With a refinance without expansion, we can do cash out for working capital. The business does need to show the need for the working capital in the next 18 months of operating expenses. The loan to value can be up to 90%. And as I mentioned earlier, we cannot include improvements into the project under the refinance without expansion program. Example here, it's a $3 million existing debt. They want to get $1.5 million cash out. We could structure this with a $2.25 million first, a $2.25 million second, and the borrower's equity is the difference. Oftentimes, banks don't like to do cash out, but at a 32% loan to value, cash out is in a sense coming from the SBA piece, and oftentimes this is a good way to do cash out for clients. This example shows refinance with expansion. So in this example, you can see that the existing debt is $700,000, and they want to do approximately $2 million worth of new construction equipment, some closing costs. And so at the end of the day, the bank first mortgage would be 1.5 million, the SBA would be 1.2, and the borrower's equity, 300,000 is accounted for. Okay, so that concludes the first piece, and Ron is going to go over some of the new regulations and some of the updates. Ron?
Yeah, thank you, Kurt. That was a good overview of the 504 loan program. Let's talk now about what's changing. So for those of you who have been in SBA for a while, every 4 to 8 years, we have a new batch of changes that impacts how we operate and administer the program. This year is no different. And this slide provides a summary of some of the recent changes that went into effect this past June with SOP 5010-8. I'll touch on these quickly, and we'll do a deeper dive on some of the more impactful ones here. So what's changing now, starting June 1st, is the franchise directory is back. There has been a few changes with how we consider credit elsewhere and the borrower's liquidity. Ownership requirements for applicant businesses have changed. The new SOP now requires 100% of the owners of the businesses to be U.S. citizens or legal permanent residences. The environmental review process has changed. Veteran-owned businesses now get priority processing at the loan center. So it's important to note that in the loan applications. The SBA has also reinstated the $16.5 million cap on green energy projects. And lastly, there has been a refocus on traditional credit factors, and how we approach our underwriting. So next slide, please, Kurt. So diving deeper a little bit into the franchise directory, I think this comes as a sigh of relief to lenders who've been trying to navigate SBA franchise requirements these past few years. So the franchise directory is back, and it makes it a whole lot easier to process a franchise loan. The difference this time around with this iteration of the franchise directory is the SBA is moving to a one-time certification model where the franchisors would sign a certification to confirm SBA eligibility just once to get listed on the directory. What that means is no more following up for addendums, no more deciphering cryptic notes in the old franchise directory. As long as the brand has signed the certification, that brand is eligible for SBA financing. There is an interim process from now until August 1st that allows lenders to continue to rely on franchise directory notes and requirements for any addenda up until August 1st. But beginning August 1st, all franchisors would sign the certification to be SBA eligible. When Kurt dropped, we lost the slides. I don't know if anyone can put that back up.
I'll do that while he gets back on.
Thank you, everyone. Just give us a second to get the slides back up here. Did you say you were going to put the slides up, back up?
Sure. Ron, are you able to share from your screen? Might be easier if you're trying to debate.
Yes, yes.
Yeah. Let me send.
And Ron, I just spoke with Kurt offline. He is actively getting back into the meeting. He was kicked out. So apologies for that technical difficulty, everyone. And he should be joining us back momentarily.
All right, no problem. How do the slides look now? Can you see them?
Not yet. Were you able to share it one more time?
Yes, here, 1 second. Oh, there we go, Kurt's back.
Okay, great.
I don't know what happened.
Would you mind
Sorry
sharing
about
the slide deck again, please, Kurt?
Sure.
We just finished franchises and we just started to go into credit elsewhere.
Coming up now. Okay, so are we?
Yes, so we just wrapped up franchises and the next slide should be credit elsewhere.
There you go.
All right, thanks, Kurt. Back in business. Thanks, everyone. Credit elsewhere. Credit elsewhere has always been a consideration for a 504 loan program. We've always had to provide a justification with our application to state why this financing is not available with SBA support. What's different this time around is we now have to consider the the liquidity of the applicant business and its guarantors. This time around, it is not a hardline test. So we at TMC have been successful under these new rules, explaining large amounts of liquidity for various reasons. For example, future medical expenses, college savings for the children, future retirement needs. On the business side, as long as we can point to future capital expenditures or justify the need for business working capital, we've been successful even when applicants or their guarantors have large amounts of liquidity. So I think the takeaway here is every case is nuanced, but we are familiar with how the SLPC, the SBA, is looking at liquidity and credit elsewhere. So, if you have an applicant with large amounts of liquidity, best thing as always is to give us a call early so that we can help you navigate and make sure that we have a smooth approval. Citizenship. So with SOP 5010-8, it now requires all applicants, all owners, direct or indirect owners of the applicant business, to be either US citizens or legal permanent residences. This changed from the old SOP that only required 51% to be owned and controlled by US citizens or legal permanent residents. What the SBA requires now is that even if we have a 1% minority owner, non-manager, and they're not a US citizen, that loan is not eligible. Even if we have a 50% US citizen owner and a 50% US corporation owner, we still have to drill down to the owners of that US corporation to make sure that they are also US citizens or legal permanent residents. This change in the SBA reinforces the current administration's mission to support American-owned small businesses. The SOP does provide some guidance for applicants, ineligible owners who wishes to divest for the benefit of the small business. So, we'll be happy to walk you through those requirements if you come across one.
So Ron, I just want to make sure, we had some questions on this. So if a business is owned 99% by a US individual or business and say 1% by a Canadian company, that is not eligible, correct?
Yeah, that currently under SOP 5010-8, that won't be eligible, even if they only own 1%.
Okay, and then as a follow-up to that, if a business is owned by, say, 5 or 6 or 10, or sometimes we've seen 15 other businesses, what do we then have to do? Do we have to look to the owners of all those other businesses?
Right, that is correct. The current SOP guidance is not only direct owners, but also indirect owners. So if the business is owned by several business entities, we then have to drill down to the individual level of those various owners of the owning business.
Okay,
That's
thank
a
you.
great
Thank you.
question. Yeah,
Thank you for clarifying.
question. Environmental review processes also became much easier for properties with no contamination. What the new SOP allows is for the CDCs, the lenders, to clear environmental reports when there is no contamination ourselves. So we don't have to send those to the SBA for approval anymore. That means we can give you a lot quicker feedback on environmental approval when the property has no contamination. The new SOP has made that much streamlined of a process. Now, the SOP defines contamination as the presence of any hazardous substances at or affecting the property either on site or that migrated from another site in such quantities or conditions that could trigger any kind of government directive or order. I think a best practice for the lenders on the line is when you are ordering the reports, it's a best practice to see if the consultants can make a definitive statement to that effect. It just makes our approval process a lot easier internally. If we are ordering the reports, all of the vendors that we do work with are pretty clear on that and allows us to approve these reports a lot quicker.
Along those lines, Ron, are we using any sort of outside vendors to assist with these approvals or review these reports? And then what can a lender expect when we do review the report by way of an approval from us?
Oh, yeah, that's a good question. So at the moment, we are reviewing all these reports internally here at TMC. All of our loan officers have a lot of experience reviewing these reports, so we're pretty comfortable that we can get a compliant approval out to you in quickly. For the approval, it's going to be a letter from us now. It's not going to come from the SBA. It's going to be on TMC letterhead that recites that this property has no contamination and that it meets the SBA SOP requirements, and that letter is going to be signed by one of our officers. So it's not going to look like the standard SBA notification that maybe you all are used to seeing. It's a great question.
Thank you for that clarification. I just want to remind everyone, because we see that there's a few hands up, but we have the ability to speak off. So just make sure you put your questions in the Q&A, and then we've reserved some time at the end to do our best to get to all of the Q&A. And if we don't, we'll certainly, answer some of these. We'll just make sure that every question's answered when we're all done here.
All right. So properties with contamination, not too much has changed around here. If the property has contamination, it does not mean that the loan is not approvable or we can't move forward with funding. All it means is that we need to provide some SOP mitigating factors for SBA review and approval. So this part of the process is no different than the prior SOPs. We will provide a write-up that describes the contamination and provide some mitigating factors and send this to SBA District Council for review. Here at TMC, our team is already accustomed and familiar with the nuances of addressing these mitigating factors, and we've had a long-standing relationship with SBA District Council to work with them and facilitate a smooth approval for you, even if the property does have some contamination. So if it's questionable, best to bring it up early to us so we can take a look at it and give you some quick feedback on how we're going to proceed with a certain environmental. Creditworthiness. This is an interesting one. This is mostly from the, on the 7A side. In the past, few years, there's been a rise of fintechs using, automated scoring models for loan decisionings and stuff. That has led to an increase of declines, particularly in the 7A portfolio. So the current administration has reinstated or has a refocus on more traditional underwriting credit standards that we are used to as lenders. So, items like cash flow, the collateral, management capacity of the owners. So the new SOP has a refocus on that. But that's at TMC how we've always approached our underwriting. We've never moved away from addressing cash flow and collateral management capacity, industry trends, and stuff like that. So this change is of little impact and pretty much business as usual for us. Just thought we'd point that out, that there is a refocus on creditworthiness, on traditional credit factors.
Great. Well, thank you, Ron. Jennifer, anything we could answer now, or some of these should we wait till the end?
I say keep going, and then we've got some good ones that are coming. We're gathering here, so I say keep moving along, please.
Okay, great. So we have a couple of examples that we'd like to show to everyone. The first one is an individual who has had multiple projects with us. We've done a variety of different purchase transactions, and then a refinance. We even did a parking lot purchase. And just so you know, a parking lot can be financed at 90%. So that's not on the special purpose list. The reason we bring up this example is that there are some folks out there that think that somebody can only have one SBA loan at a time. And that is not the case. There are some limits, as I mentioned in the beginning, as far as the aggregate amount and ways to exceed that total $5 million cap. But there's not a limit to the number of SBA loans that a business can have.
So this is another good example of 504 using for ground up construction. In this particular project, it was just under $8 million total project cost. We were able to finance the build out of a new school for this business. The applicant utilized the green program, and interestingly enough, this was also on a ground lease. We didn't mention that before, but building properties on a ground lease is also eligible for the 504 loan program. And we were able to structure this loan with just 15% down from the applicant, which allowed them to retain the needed working capital for their new school startup.
We do a lot of hospitality lending, a lot of different types of special purpose property. This particular applicant has financed over $20 million in two different hotel projects, and is now working with us on a third. So idea being that especially with the green program and the ability to exceed that $5 million cap, and our outlook on hospitality lending, these are some really good qualities that the 504 program has.
And what's next? Full body Pilates. This is a favorite one of mine. The owners are super sweet. This is a good example of us using the 504 refinance program to reduce their occupancy costs. So we were able to refinance a variable rate 7A loan for them, 25 years fixed. The borrower also took some cash out and was able to maintain only 10% minimum equity in the building, and still able to reduce their occupancy costs going forward. So this one was a good success story for us.
Okay, so I'd like to talk a little bit about the timeline for SBA 504 financing. We generally can get a deal pre-qualified within 18 to 48 hours. That is really helpful when you have applicants that are in contract and they're looking to purchase a building. They want to know if they can move forward. But it's also useful with applicants that are not in contract, who are thinking about the idea of buying a building. They kind of want to know the range of what might work. And so we're very happy to work with applicants in an early stage and seeing if they're seeing what range they might be in. But also another important thing, that something might come up in our pre-qualification review, which takes time to resolve. Maybe it's a credit issue, or maybe it's cash flow isn't as strong as we would need it to be for them to buy the size of property that they want. So by us doing a pre-qualification and getting that information back to your client with how it looks now or how it might look in the future is very valuable. Once a deal has been pre-qualified and is in contract, it moves to the underwriting stage. We have, I believe, 13 loan officers that we are on our team, and our loan officers are experts in working on our credit memo, analysis, eligibility, and when they're working on the underwriting piece on their end, the bank is concurrently working on the underwriting on their end. the appraisal is being done, the environmental report is being done. And so once all of the underwriting, usually 3 to 4 weeks, is finished and we have the reports back, we can submit on our end to SBA for approval. Currently, the SBA is taking about 8 business days for their review. Sometimes that's a shorter time period of time. Sometimes it's longer, depending on the capacity at SBA. But currently, it's about 8 business days, and hopefully we get the approval on the first pass. Once we have the approval, we can move towards closing. And at close of escrow, we strive to have what we call a simultaneous signing, where the applicants sign our bank loan or our SBA loan docs at the same time that they're signing the bank's first mortgage, the interim loan docs. So they strive to have them sign all 3 sets of loan docs. Even though there's no money coming from the SBA at the close of the escrow on the purchase, it allows for the applicant not to have to go back into escrow and sign loan docs a second time. We can have our docs signed and move forward. We can't do that on deals with construction or tenant improvements, but we can do that on straight purchases. So after the close of escrow, it does take us 45 to 60 days to get what's needed to fund the SBA permanent loan. And once we fund the SBA permanent loan, then the loan is with our servicing department, and any questions on the loan at that point, we'll give you the contact information for our servicing team. The pre-qualification is a limited amount of information that we need. 3 years of personal business tax returns, personal financial statement, interim financials, business debt schedule, and a general understanding of the file. We have a PDF we could send off to you in order to get the information we need. We can work directly with you and or the borrower to get what's needed for the pre-qualification. Okay, and with this, I would like to introduce Jessica Pachev, our closing manager. Jessica's going to go over some information about closing and then also touch upon servicing. So Jessica.
Thank you, Kurt, and hello, everyone. My name is Jessica Pachev. I'm the closing department manager here at TMC. I'm really excited to spend the next few minutes with you as we dive into the world of loan closing. Let's get started and take a look at a few key considerations to help ensure a smooth SBA 504 closing here. So first, I'd like to start off and say for straight purchase transactions, it is really important to align the signing dates between the CDC and the lender. So making sure that those dates are coordinated up front is a really big help. It does ensure that our closing officers can prioritize accordingly. Like Kurt mentioned a little bit ago, we do prefer to sign together on straight purchase transactions. And so making sure that TMC is informed of the loan signing dates is important so we could get those docs drafted and over at the same time. Next, I cannot stress enough the value of bringing our closing team into the process early. The sooner that we're involved, the easier it is for us to help coordinate between different parties, spot potential issues that might be hiding in these loans, and just keep everything on track. Talking about seller credits, these do reduce the purchase price of the project, so we do need to make sure that they're properly documented. They can impact the loan structure, so clarity is important on that one. Moving on to the lender term, to avoid needing an extension, lenders should ensure that their loan term is long enough for the SBA loan to fund. SBA will accept no-call letters or extensions for maturities, but it's best to keep track of these. And another critical item is the lender certifications and agreements, such as the interim lender cert, the third-party lender agreement. They do need to be signed and returned promptly. They need to be completed and recorded before we could submit a loan for debenture funding. So this is a very important piece here. And lastly, a quick reminder on an eligible closing costs. These are costs that cannot be financed within the 504 funds, and they include things like property taxes, broker commissions, lender origination fees, and any improvements made to any portion of the property that the borrower won't actually occupy. All right, moving on to construction loans. We actually received quite a bit of questions on this. This seems to be people's favorite topic, and I know it's very exciting. These are loans that include ground up construction or any loans that involve any amount of tentative improvements. So that's categorized in our construction loans. For those of you working on construction deals, it is important to note that TMC has a dedicated team of experienced closing officers. They're seasoned, they're experienced, they're knowledgeable in all aspects regarding SBA construction loans. They do periodically check in with the lender to stay updated on the status of project completion. So it's just as important for you as a lender to keep us informed of any changes to things like the scope of work, project costs, loan amounts. These changes can affect timing and eligibility, so communication is key. And also, the SBA funding cannot occur until the construction loans are fully dispersed, meaning the first and the second must be fully dispersed before we can move forward with SBA submission. Construction loans can vary. So any construction-related provisions that are outlined within the terms and conditions must be fully satisfied before we can proceed with SBA loan funding as well. I've included a brief list of items that are commonly required for construction loans. Just note that all items will, not every item may apply in every case. Requirements may vary depending on the scope of the construction project. And so these are general rules, and it may not highlight the specifics on the loans that you're working through. So please feel free to reach out to us directly if you have any questions, comments, concerns on construction loans.
Jessica, we had a few questions posed ahead of the call. One of them is, are the documentation requirements the same from CDC to CDC when it comes to what's needed to submit a loan to SBA for funding?
Great question. Yes, they are. So CDCs are following the CFRs and the SOPs. So what is required will be the same across the board. Where you may see some variance is depending on the type of construction loan that you currently are working on and have.
Well, doesn't it also sometimes, Jessica, vary on the district council that the SBA's closing attorneys? Sometimes, from what I understand, some closing attorneys are more strict at interpreting some provisions and others are less strict.
We do see variances within district offices. However, we don't see variances if it's included on the terms and conditions. So whatever's on the terms and conditions must be fully satisfied, no matter what district office it's going to.
Great. And then a follow-up question to the comment that the loan must be fully dispersed, or the bridge loan. Is there a situation where the client can get cash out, or if they come in below budget, or conversely, if they're over budget, is there a way that, we can accommodate increases specific to construction loans?
So we cannot give money back to the applicant. However, you do pose an interesting comment of saying that the costs do fluctuate. And that is actually one of the reasons why we do not do the concurrent signings or the signings together with the lender that Kurt was mentioning earlier, is because we very often see loans and costs changing that do require us to make a change to the terms and conditions that were initially processed and approved. So we often do see, on almost most construction deals, that costs do change, and it does require us to make changes to the TNC.
Thank you. Thank you for clarifying.
All right, next we have a slide that outlines the required documentation for closing. And I won't go through each line item during this call in the interest of time, but I do encourage you to review them carefully. And if any of these line items are unclear or you have questions about what's specifically needed, please do not hesitate to reach out to me directly, and I'll be happy to walk through any of these items. All right, to wrap up on the closing side, I do have one servicing section after this, but I would like to invite you to reach out. We are happy to meet with you or your internal closing team to walk through the process, talk through any project-specific concerns, or just answer questions along the way. Our goal is to make sure that every transaction closes as smoothly and as efficiently as possible. I know that can be hard sometimes. There's a lot of cooks in the kitchen, so it takes a village. So yeah, don't hesitate to reach out. You can contact me directly and schedule time for yourself or your team, and we'll make sure you get the support you needed. I have a QR code here that you could scan with your phone.
Thank you so much, Jessica. I really would encourage everyone to consider a private presentation by Jessica and maybe one or two of our closing teams for your bank. There's so many nuanced situations with closing, and it's how the deal is left with the customer, and it's really important that we get that correct. And by having all of us be more aware of what's needed in order for us to meet the SBA requirements, I think we've seen a lot of value in banks that reach out and ask Jessica to give a presentation about closing specific to their bank. So please do reach out to Jessica if you'd like to set that up.
All right, thank you. And before I wrap up, I also wanted to highlight that our servicing department is here to support loans long after they funded. So should you have any questions or concerns on funded loans, or if borrowers are requesting a 1098 form, please don't hesitate to reach out to the servicing department. They are an incredible resource. They're always happy to help. You'll find their contact info on the screen here, an email, a phone number, a link to our website. And then just lastly, wanted to say thank you so much for your time today. I really appreciate the opportunity to be able to speak with you. And we do look forward to working with you and your teams. Back to you, Kurt.
Great. Thanks again, Jessica. I'll go over a couple of resources and then a recap, and then we'll get to some of your questions. One thing I would like to point out is we have another loan that can be really valuable to your clients. It's called an SBA 7A Community Advantage Loan. These are for loans, requests for working capital, generally working capital, although we can do commercial real estate, with amounts of $50,000 to $350,000. While I'm talking, feel free to scan the QR code and get some information about how to connect with our director of the Community Advantage Program, Anna Lavanger. But these are loans. Maybe the bank just doesn't want to, mess around with a $50,000, $100,000 loan, but your client needs it. So we are here for a source of that type of request. There are terms of 7 to 25 years, prime +1 to prime +3, depending on several different factors. Wide variety of business uses for the capital. We can only do projects in California, Arizona, and Nevada currently. We had been having some plans to expand into Hawaii and Oregon, but they were curtailed by SBA. SBA wanted to kind of limit some of this, but we are able to do projects in California, Arizona, and Nevada for the Community Advantage Program. So please reach out to us if you have some questions in that regard. Another resource as an affiliation determination. This chart may look overwhelming. Don't expect you guys to be an expert on this one, but if you would like to know how SBA views affiliates, there is a nice flow chart here that describes it. The important part of this is that when we look at that $5 million cap that SBA has, that is for the borrower, what we consider the operating company, and any affiliates it owns. So that's how the $5 million is aggregated. However, a lot of businesses that are owned by an applicant are not considered affiliates. And so if for example, a business owns a gas station and has a $5 million loan, an SBA loan for that gas station, and that business also owns a hotel, well, that hotel is not considered an affiliate because it's a different industry type. And so that same individual can have a $5 million loan for their gas station and a $5 million loan for their hotel business. So determining if a business is an affiliate or not is an important step in determining the maximum dollars that an SBA, an applicant can have. If you'd like the flow chart, let us know. A lot easier would just be to call us, one of our business development officers, and we can go through this flow chart pretty quickly. Another resource for you is a flow chart in regards to the refinance without expansion product. There's a wide variety of things that are needed to be reviewed to see if an existing loan is considered qualified by the SBA for us to be able to refinance it. It's a nice flow chart. We can send it to you, but again, don't hesitate to call us, and we can do this for you. You can connect with us and any of our 13, soon to be 14 business development officers via our website. So please reach out to us. We definitely want to talk to you about any and all requests. I also encourage you to visit our website. You can scan our website. You can bring up our website by the QR code. It's pretty easy, tmcfinancing.com. Our website has the contact information of our business development officers. It has a 504 calculator where you can plug in different project costs and see what the potential rate and payment might be. We have the rate updates that were announced today, but if in 2 weeks you kind of forget what the rate is, it's on our website. We have a frequently asked questions section. We have success stories. We have SBA loan comparisons where it compares conventional to SBA 504 to SBA 7A. And then we have some information on our Community Advantage offer. So I'm going to leave this last slide up. This is our last slide. I'll leave this up so you can kind of look at that while we take some questions.
Wonderful. Thank you, everyone, for your questions. So the first one I have here is for Ron. Does the 504 allow costs to be at a 93% loan to value? Or is that allowed, I guess, right? To have your loan to value or your advance rate above the 90%?
Yeah, actually, believe it or not, we said that it was maximum 90% LTV, but there are circumstances where we can exceed that on an exception basis. If the applicant demonstrates, good management ability, solid cash flow, it is possible to get an exception to go over 90%.
So in the event of a short appraisal, oh, sorry, go ahead, Kurt.
I'm sorry to interrupt you, but I was going to say that the important thing to consider is loan to cost. So the applicant still has to come in with 10% of the cost, but if as you were about to say, Jennifer, if the appraisal came in a little bit short, but the applicant is still coming in with 10% of the purchase price, almost, generally speaking, I don't want to say almost always, SBA is okay with a higher loan to value than 90%.
Yeah, good point. 90% loan to cost, but it is possible to go over 90% loan to value.
Excellent. Okay, I have another one here. If a 7A customer who obtained a construction loan and just completed the project wants to refinance it to get the benefit of the reduced rate of the 504, can this be refinanced even though there's been no income generated yet?
You want to take that one, Ron?
I've had a
Would you
longer
mind?
time to digest. So
would you mind asking that again, Jennifer?
yeah,
I was
I
trying.
mean, so if you have a client that obtained a 7A to do a construction loan, and now they are looking to refinance that with the 504, but they have not yet started generating income, is that a possibility?
That
I
that's a
think
really good question.
I think
Sorry,
I understand. So generally speaking, number one, the 7A loan would need to be on the books for at least 6 months, and the other
I think the other challenge you're going to
2
have is they
years.
don't have 2 years in operation.
Yeah,
Correct. So
so we have to
unfortunately,
have. Yeah, one of the requirements for the SBA 504 refinance without expansion is that the business has to have been at least 2 years old. So if it's a newer business, then no, it would not be eligible.
But if it's if it's an existing business with 2 years of operations and they built ability, that would be eligible, right? After 6 months after the last disbursement, if they're more than 2 years in business and they're currently occupying the property, I think that would be eligible.
Yep, good nuance there. Yep.
all right. Do the SBA disaster loans that clients obtained during COVID or any other disaster time, do they affect the maximum loan limit or maximum amount of dollars available to them?
No, and this is a really important one. So if somebody has an EIDL for $3 million, that counts as zero towards their $5 million cap. PPP, EIDL, USDA, those types of loans do not count for the SBA cap.
Yeah, it's really 7A and 504 that's not green.
All right, here's a new one that just came in. Can you revisit the maximum loan aggregate to one borrower that's allowed? SBA
Yes.
loan dollars.
So
Yeah.
yeah, I historically it was somewhat tied to somebody's social security number. That was the conception, and that's not the case anymore. So the concept is that the SBA looks at the applicant business, so what we would consider to be the operating company, and any affiliates that are associated with that operating company. And that was that big flow chart, which again we can show you and send to you. If a business that the individual owns is not considered an affiliate, then that separate business can have its own $5 million. So one individual, I could have 3 or 4 different businesses that are in, let's say, different industries, and they're not considered affiliates. I could have $5 million with this business. I could have it with this business and this business and this business.
Excellent. And along the lines of affiliation, can you speak to investment real estate LLCs? Are they automatically considered an affiliate, or are they, excluded dependent upon the ownership in the NAICS code?
The latter. Affiliation now is not control based anymore. It's ownership based, and there's also the caveat that it has to be in the same industry.
So, for example, a real estate LLC would be potentially one industry, and the barbershop that somebody's financing would be a different industry.
Right, exactly. And then another important note is that when we're looking at industry and affiliation, it is of the operating company. We don't have to consider the real estate holding company.
Excellent. I'm going to direct this. This came in during the closing, Jessica's presentation, but I think maybe I'm going to address this more to Kurt because I don't think it's asking about the very specific insurance requirements, although we can certainly respond and get those to you. But it's really about insurance requirements and the impact on the current environment on SBA financing. So are clients having difficulty, I think, obtaining the required insurance?
Yeah, that can be challenging. And especially with the fires and disasters we've had in some areas. I also know that, for example, in Hawaii, sometimes wind insurance is required. So we do have to meet SBA requirements. If it's listed in the terms and condition is the SBA approval document. If people don't know that, if it's listed, if a certain insurance is listed in the terms and conditions, we have to follow that, and we have to get that insurance in place before we can fund the loan.
Okay.
Which is, I know, sometimes tough to get, but that's the reality.
This is along the lines of a topic that we were on not too long ago. Please clarify what you mean by the 16.5 million in total SBA financing. And this is specific linked to the green energy. So if you could just expand on what that means, the 16.5 million with regards to green energy.
There was a time where someone could have unlimited numbers and an unlimited aggregate amount of green energy projects. What the latest SOP instituted was a cap. So a cap of 16.5 million aggregate. So someone can have 4 different $4 million green projects, because that would be under the 16.5 cap, but they cannot have 4 $5 million projects because that would exceed the cap.
Mm-hmm. So as a rule of thumb, if we're maxing out green debentures at 5.5 million, it's 3 max per borrower.
3 max or 5 under max, or a higher number. It's not I guess my point of saying that was there's no limit to the number of green projects that someone can have, but the aggregate is limited to 16.5.
It could be 16 $1 million
projects.
Yeah.
Okay, and it looks like we have a client that was well on his way to doing that based on that example you showed us earlier. This is kind of an interesting one. Does a parking lot need to be paved? So I'm assuming this is maybe a land loan request. I don't have the specifics, but I'll let either one of you take that.
I would say no. The business does need to use the land as it is, and it might be difficult for us to say that a business is going to be using land that is just dirt, because it could get muddy and it might not be very useful. So I think it's generally best if that land is graveled, or you have some sort of fence around it would be nice too. But it's not explicitly required, but we do have to address how that business is going to use it, and make sure it's still a good business use for that business.
Wonderful. We just got some clarification. It's used to park trucks. So
Okay.
There you go.
I would agree with Kurt. It really depends on the operating company and their use of it. So if we can demonstrate that they can park their trucks and it's dirt, I don't think it necessarily needs to be paved. We just have to demonstrate that the operating company can use it for their business and generate revenue.
And that is not special purpose, correct?
Correct. 90% on land.
Wow. Oh, okay. This is a good one. Can you speak to turnaround times, loan approvals, 327 approvals? And is there any way to have it shorter than the current turn times?
Ron, I'll let you take this one.
Great question.
Or reduce the time.
To reduce the time. Currently at the SBA, it's about an 8 business day turnaround. We found the SLPC is currently still catching up from the 4th of July holiday and summer vacations and stuff. So temporarily at the moment, turn times are a little bit longer than we're used to, at about 7 to 8 business days. At TMC, we're what's considered a delegated lender. So what that means is SBA has delegated us certain authority to approve loans without sending them to the loan center. So we do have a process, for that. If if we're coming up on turn times, we might still be able to use our delegated authority to approve the loan faster than that.
I'd like to point out, well, but before you, Jessica, I'd like to hear about maybe the 327 that you might address, but happy to consider what Ron was referring to as the PCLP or PCL approvals. That is something that we can approve on our own. I do want to stress that TMC does take financial risk in those requests, so it's not something we enter lightly. If it's a stronger deal and it's needed to meet a certain timeline, and we just do not have enough time to submit the loan to the center for approval, we will consider those, and that's something that not every CDC has, and even those that have it, many of them don't use it. So it's a really nice advantage that we have and we use, but we do have to be somewhat judicious in our approvals of that method. Jessica?
Thank you. And let me just say, when it comes to 327 turn times, I dream about them. Okay, it's on everybody's mind. They've been taking a lot longer. It is something.
Jessica, I'm sorry to interrupt. What is a 327? Can you, for the folks who don't know?
A 327 is a action to amend something that was on the terms and conditions. So once that terms and conditions is approved and issued, any changes that come to that regarding adding or removing insurance, updating names, updating the lender name, updating costs, any change that needs to take place is done via a 327 amendment document that is filled out by our staff here and sent to the Sacramento Loan Processing Center. And that's where it may get stuck in a queue. So they're very backlogged, they're short-staffed. We've tried it all in terms of reducing the time. We have put in bold red notes on our 327 that it is a rush. We followed up with them, after they've been submitted, but unfortunately they're in a very large queue. So what we're seeing right now with 327s is about 8 to 10 days for simple 327s. Any 327s that may not be as simple that are required to go to legal versus the Sacramento Loan Processing Center actually may take multiple weeks. So we are trying our best to be proactive and get started on them as early as possible. But unfortunately, we are not able to reduce the turn times at SBA.
All right. We have a few other questions coming in, but I think we can quickly reply to these in the chat. So we want to be respectful of your time. We're at 2:32. So I'm going to turn it back to you, Kurt, to wrap it up.
Wonderful. Well, thank you everyone who joined. As I said in the intro, I'm not sure what the number we got to, but I think it was close to 300 that joined the call. I know there was 500 that registered. That just shows a lot of interest that you guys have for small businesses and the communities where you operate. I also will stress that you do not have to remember all of this information. This is our job. This is what we like to do. So please call us. Go to our website, look at all the 13, soon to be 14 business development officers that we have that you can work with. We'd love to talk to you. And if you need a private, I mentioned a closing seminar that Jessica can lead. If you want something like this, more intimate for just your bank, we would be happy to set these up for your bank as well. Ron, Jessica, do you have anything else on your end?
No, I just want to echo what you're saying. I think we're all here under a common mission, common purpose is to help and serve small businesses, deploy the capital needed for them to continue to grow and be successful. And 504 is a great tool for that. So, always happy to talk 504 loans. Give me a call, give us a call, give one of our business development officers a call.
Wow, and you both said that so well. I have nothing to add. But thank you for getting on and thank you for your time. Really appreciate it.
Thank
Okay,
you,
everybody.
everyone.
Thanks again. Bye.
Bye.